Most retail Forex accounts lose money. The survivors aren't running clever strategies. They're running boring rules.
Most retail Forex accounts lose money. That's not opinion. It's printed on every FCA and ESMA disclosure your broker is legally required to publish. And the uncomfortable part isn't that people pick the wrong strategy. It's that the traders who survive aren't running a clever setup. They're running boring rules, a written plan, a trade journal, 1% risk per trade, a weekly review. That's the entire moat. Before we walk through them, hold one number in your head: 14. 14 losing trades in a row. That number explains why most retail accounts blow up on strategies that actually work on paper. We'll come back to it. Risk per trade. The professional ceiling is 1% of your account on any single trade. Many institutional desks run at a quarter of that. Why so paranoid? Variance. Even a profitable strategy will hand you 10 losing trades in a row. It just happens. Now do the math. Risk 1% per trade, and you'd need 100 straight losses to wipe out half your account. Risk 5%? 14 losses cuts you in half. 14. That's the number. And 14 loss streaks happen on real, profitable strategies all the time. The trader risking 5% isn't being aggressive. They're already gone. They just don't know it yet. And position size isn't a lot number you pick. It's derived backwards from where your stop sits. $10,000 account, 30 pip stop, 1% risk, that's $100 on the line, and the lot size falls out of the pip value of the pair. Run that calculation before every trade. Not most, every. If you can't size by stop distance, you don't have a risk rule. You have a hope. Which brings us to the two artifacts most retail traders refuse to write: the plan and the journal. The plan is 1-page minimum. Your strategy, your risk rules, the pairs you trade, the sessions you trade, your maximum daily loss in % of equity. That's it. The point isn't bureaucracy. The plan gets written in calm hours when you're thinking clearly, and it gets executed in live hours when you're not. Without it, every trade is improvised. With it, every trade is measurable. The journal is the other half. Every trade gets logged. Setup, entry, stop, exit, size, result, in multiples of risk, what traders call R, and one sentence on what you were feeling at the time. One sentence. Skip the journal and your weekly review runs on memory. And memory selectively remembers your winners and quietly deletes your losers. That's not paranoia. That's how human brains work. Trades that get journaled get reviewed. Trades that don't get journaled get repeated. A spreadsheet works. Trader View works. Edgewonk works. The format is irrelevant. The consistency is everything. Now the part that costs people the most money structurally: pair selection and broker setup. Most beginners trade everything the broker offers. That's an expensive instinct. 2 or 3 pairs maximum until you have hundreds of trades of real data. Euro US dollar, GBP US dollar, USD JPY, tight spreads, deep liquidity, well-documented behavior. Skip the exotics. USD TRY moves big, but the spread eats you alive and the event risk is brutal. Specialize first. Diversify later, if ever. Broker choice is the second cost lever, and people get it wrong because they're shopping on the words commission free. That's marketing. Spread-only accounts hide their cost inside a wider spread. You pay either way. For active strategies, raw spread plus a transparent commission on a Tier 1 ECN broker is almost always cheaper. The Tier 1 regulators worth recognizing: FCA in the UK, ASIC in Australia, CFTC and NFA in the US, BaFin in Germany, MAS in Singapore, FINMA in Switzerland. Anything else, treat as a downgrade. Avoid bonuses with turnover requirements. They lock up your capital. And cross-check the license number on the regulator's actual website. Scams use real broker names with clone entities behind them. Then the silent killer: psychology. The failure modes are predictable: revenge trading after a loss, over-trading out of boredom, plan abandonment during a winning streak, confirmation bias, hunting for setups that match a view you already have, overconfidence after a hot streak, sized up just in time to give it all back. They share one root cause: you're trading with no mechanical break. The single most effective fix is a hard daily loss cap. 2 to 3% of the account and you're done for the day. Forced, not optional. Pair it with a 5% monthly drawdown rule that benches you for a full week. That week off feels expensive. It isn't. The cost of trading through emotional fatigue is much higher. One more piece worth knowing: the tips that sound clever but don't help. Cut losses and let winners run. True, useless without specific rules. The trend is your friend. Fine, tells you nothing about entry or risk. Don't let emotion control you. That's the problem, not the solution. These tips circulate because they sound profound and require zero work to repeat. The useful ones are the opposite. Pre-commit your stop and never widen it during a trade. Never average down a loser. Both of those are the same instinct, you trying to negotiate with the market and the market doesn't negotiate. Use a checklist before each entry. One missing condition kills the trade. Take partial profits at 1R. End every day with a journal entry, win or lose. Boring, mechanical, they work. Session selection ties this together. Forex runs 24 hours, but the meaningful liquidity is the London-New York overlap, roughly 12 to 1600 UTC. Tightest spreads, highest volume, best fills. The Asian session is quieter, better for mean reversion on AUD USD and USD JPY. And the practical thing, pick the session that matches your actual life, not an aspirational schedule. The London trader who tries to grind New York hours becomes exhausted and inconsistent. Tired traders make bad decisions. The routine pulls it all together. Pre-session, read your plan, check overnight news. During session, take only setups that match the plan exactly. Walk away when the cap hits. Post-session, journal every trade. End of week, review against the plan. End of month, compute expectancy by setup and retire anything that stopped working. So here's the verdict. The tips that survive contact with real trading are unglamorous. Plan, journal, 1% risk, 2 or 3 pairs, tier 1 broker, hard loss cap, weekly review. None of those are secrets. None of those need a course. The reason most retail traders ignore them is they're boring. The reason a small minority survives is they don't. Remember that 14 loss number from the start? That's the equation that decides everything else. Get your risk per trade right and you survive long enough for your edge to actually compound. Get it wrong and no setup on earth saves you. If you're willing to run the boring rules for a year before you expect anything meaningful in your P&L, Forex works as an asset class. If you're chasing a signal service screenshot, this isn't your game. Walk away from the asset class entirely. It will be cheaper than learning the hard way.
Discipline beats strategy. Run the boring rules and you survive. Full breakdown linked in the description.